high level, do people with good credit, are they going to have to pay more now to subsidize people with bad credit? Yes or no?
Hey guys, running around at home, but I wanted to share with you an interview I recently did with George Adams at First National Bank to talk about Biden's new program, which is subsidizing people with poor credit by charging people with good credit a little bit more money in fees. It's not as black and white as that, so I want you guys to see the interview and give you guys what I'm a firm believer in, a game plan for short, medium, or long term, whether you're looking at buying or selling, so you guys can make a good decision, because at the end of the day, the more information you have, the better. I know I learned a lot from the interview. I hope you guys learn a lot as well. And with that said, let's get into the interview. Hey, it's Joel Gableman with Gableman Group, Real Brokerage. If this is your first time to the channel living in Cleveland, welcome. Of course, we cover real estate. We also cover anything I think you guys might find interesting. Fun things to do with the family, places to go, food, drink, you name it. I try to showcase what it's like to live in Cleveland, Ohio. We focus on families that need more space. So whether you're upsizing because your kids are getting bigger, you're having more kids, or maybe mom, dad, and in-laws are starting to move in with you, give us a call, text, email, or even schedule a Zoom call with me. Those links are in the description. And we get calls from people in the city, outside of the city, outside of the state, and sometimes outside of the country, and we love helping people out. With that said, let's get into the video.
May 1st, I'm getting a lot of feedback on Biden's new ruling, which is that people with good credit are going to subsidize high risk loans. In other words, people with good credit are going to have to pay more in interest in order to offset high risk or low credit, poor credit borrowers. And I've been getting a lot of feedback from buyers who are just hearing about this. And most people, bankers included, they're not fully aware of everything going on, but the good lenders that I work with are very much on top of it. And I'm very fortunate to have George Adams, one of the best lenders that I work with at First National Bank. I was fortunate just to give some guidance, feedback, and color just about what's going on in the market, how buyers and sellers can prepare themselves. And with that, George, thank you for being here. So my audience and people can get at least some comfort and ideas if they're thinking of buying or selling. Tell me more. What's going on? Is that accurate that the Biden administration is having people with poor credit get essentially subsidized from good borrowers?
It's a stretch at best, Joel, and thank you for asking, right? What it is it's new loan level pricing adjustments that came down from the FHFA. It's the Federal Housing Finance Agency, and that is the government-sponsored enterprise that is currently the custodian of Fannie Mae and Freddie Mac. What it's part of is the Affordable Housing Initiative, and they're trying to make home ownership more affordable for everyone. There are a couple of products out there for low to moderate income borrowers, being Fannie Mae Home Ready and Freddie Mac Home Possible, that waive loan level pricing adjustments for certain low to moderate income borrowers. There are also some incentives out there right now as part of this, where the loan level pricing adjustments are being waived altogether up to 100% of the area median income for a first-time home buyer. The threshold really hasn't changed for good credit borrowers, right? What you're looking at is that the disparity between the low credit borrower and the high credit borrower has closed. Where it used to be, it might be 1.5 in interest rate difference. There may only be 1/2 or 3/4 of a point difference in interest rate today.
Okay, so I had an old boss who used to love quoting the movie Philadelphia, where the doctor goes through all this stuff with Tom Hanks's character, and Tom Hanks looks at the doctor and says, "Explain it to me like I'm a 7-year-old." So maybe it's not as simple, but George, if I explain to me like I'm 7-year-old, high level, do people with good credit, are they going to have to pay more now to subsidize people with bad credit? Yes or no?
Certain borrowers, maybe; most, no.
And if they are paying more, is it substantially more, or maybe like 1/8%? They're not paying 1/4 or 1/2% more, or are they?
It's 1/8 to 1/4 in interest rate at most. What loan level pricing adjustments are is an adjustment to the price. I believe the worst I saw was 0.375% of the amount they're looking to borrow or higher in cost. You could easily offset that with 1/8 or 1/4 point increase in interest rate, or you could simply pay the difference.
Just to make the math easy, so people can understand, if it's $100,000 loan, they're 1/4 point difference. Is that you're saying it's not an add-on to the rate?
It's an
It's
add-on to the price, which could be paid for out of pocket or by increasing the interest rate. And if you're working with a good lender, they should be explaining both options to you as a buyer.
okay. So the add-on cost, you said it would be about a quarter point, or in that case, $250 on $100,000 loan.
Correct.
So
Or 0.375 would be $375 on a $100,000 loan.
so every $100,000 would be between, call it, 250 to $375, which it's not great, but it's not like your interest rate is going to go up a quarter point because that's going to be forever.
And it's a very narrow spectrum of those borrowers at specific credit scores and specific loan to values that are being impacted, right?
Okay.
Every borrower, whether you're a good credit score or a low credit score borrower at 3% down, if you qualify for that program, is looking at a better interest rate today than they were before. It's not a one size fits all thing. There is a small
Okay.
group in the middle of the pool there based on credit scores and down payment, debt to income ratio, things like that, that would be negatively impacted. Most across the board, or the majority of borrowers, are going to see the same rates they would have seen months ago or better. And the reality is, this has been around since January. All of these new loan level pricing adjustments were rolled out to us in the industry in January because they're not effective as of May 1st. They're effective with loan deliveries as of May 1st.
I
So, what
see.
that means is somebody that applied for a mortgage loan in mid to late February that had a 60-day closing would have already had these pricing adjustments built into their loan.
So somebody who's thinking about buying now, is there any special guidance above and beyond? It sounds like A, this isn't going to affect every buyer, just some buyers and just some people. And two, as far as strategies or some things that buyers could do, maybe they'll be affected, maybe they won't. I know that there was a physician we were working with, and portfolio products or products that aren't sold to the secondary market that banks do themselves typically aren't affected. But any other strategies a buyer should do? Should a buyer wait longer? Should they move faster? Does it not matter?
A borrower should, as I would always recommend, talk to an experienced lender, and maybe more than one, who has different products available and can talk through the different options available to them. I always like to go back to waiting has never been one of my favorite philosophies with buyers. And it's simply because over my 20 years in the business, I've seen housing prices go backwards once, right? More times than not, your housing expense in general is going up, whether it be to rent or to buy. And housing, real estate in general in this country has always been considered a really good investment. If you talk to any financial advisor, they're going to tell you almost across the board, there's never a bad time to make a good investment. And real estate has been one of the safest investments across the board in this country, really, as far back as we've recorded history on property values.
I had a call with my financial advisor, and he said to me, "Good news, you're up 10% over the last 5 years." I said, "That's less than 2% per year when you take into account compounding. I'm losing purchasing power relative to inflation. That sucks." He's like, "Well, you're not negative." And I said, "Had I put that money in a bigger house, I would have been so far ahead, you know?" So, well, that's good to know. So the buyers, they should talk to an experienced lender, even if they do get hit. It's not, as a recap, it's not going to be, thousands and thousands of dollars. You're looking at an add-on of cost of, call it, 250 to 375 for every 100,000 borrowed, and that doesn't apply to everybody. What do you see, though? I mean, nobody has a crystal ball. I tell my clients all the time that it sometimes feels like I have a cape and I have superpowers, but I don't. But tell me, what do you see in the banking world as far as short term, let's just call it 2, 3, up to 6 months out, long term, 6 months plus out? Do you see things getting better as far as rates? Do you see things getting worse, stable, or it's a roller coaster? You're along for the ride. What are you seeing?
Short term, we're really subject to what happens in the market and what the key indicators that the Fed is watching for inflation. All of those things that move the market are coming, right? Once the Fed gets to the place where they're happy with the numbers they're seeing, both on the inflationary data that they're looking at and in the jobs report, where they feel like we're moving in the right direction and they put a pause to this thing. The anticipation amongst the people that follow these things and the experts, I don't claim to be one of those. If I knew what was coming, I wouldn't be talking to you right now today. I'd be sitting on a beach somewhere working an hour every morning and winning in the market. So the experts in the industry that I follow and that I read a lot on are expecting that once the Fed is happy with the information that they're seeing and they put a pause on interest rate hikes, we're going to see an improvement on your long-term interest rates, your 30-year fixed, your 15-year fixed, your 20-year fixed interest rates. Is it all going to come back all at once? Probably not, but they're expecting by the end of the year that we should be seeing improvements.
No, I appreciate it. I don't know if that's my dog or your dog, but the joys of working from home, from office, and the new world we're in. But hey, I really appreciate you giving your feedback. So the recap is that it's not going to affect everybody. Fed's changing things around. We're along for the ride, but in general, the short-term sentiment is that rates are the idea is that they will be improving a bit. And people should definitely speak with a good lender, maybe even a couple for the different products. And I will put George's information below so you can reach out to him. Certainly reach out to me if you have questions on the real estate. But I'm grateful to have you on and get your brain picked a little bit. It's always something new, always something changing. And I'm getting more and more people calling up and asking what I know about it. And I would rather have somebody who's got their finger on the pulse of the lending world a little bit better and could hear from someone like you. Well, what do you guys think? Is this a good thing, a bad thing? I'd love to hear your guys' comments in the comment box. And of course, if you have specific questions on your individual needs, whether buying or selling, give me a call, text, email, or schedule a Zoom, and I'll see you in the next video.